Good afternoon, everyone, and welcome to our next wave of royalty companies webinar. We have 3 companies presenting today, so it should be an exciting talk. My name is Derek McPherson. I'm a Vice President and Equity Research Analyst at Red Cloud Securities. The reason this is interesting is royalty companies are considered to be a lower risk way to gain commodity exposure, as they benefit from rising commodity prices without the operating risk. However, once they reach a certain size, like Franco-Nevada, the ability to add meaningful growth is difficult. And so here we have 3 brand new entrants into the royalty space where they have that ability to grow with each acquisition. On today's webinar, we're pleased to bring you 3 companies. I have with me today Kyle Floyd, Chairman and CEO of Vox Royalties, Joseph Delaplante, CIO of Nomad Royalties, and Adam Davidson, CEO of Trident Royalties. For this webinar, each company will give about a 10-minute presentation. After each presenter, we'll take questions live from the line for 5 minutes. And at the end, time permitting, we'll take some general questions on the royalty landscape, but we'll see how the time goes. As a reminder, at any time, you can type your question into the chat, and we'll try and get to as many as we can in the time allotted. What I would ask is that if you do have a company-specific question, that you note the company that you're asking it to, just so I can keep the questions straight. So to start with, the presenters, in order, the presenters will be Vox, Nomad, and then Trident. So to start with, I'll handle the disclosures. For all 3 companies, there may be forward-looking statements made on this webinar. I direct listeners to the cautionary note on page 2 of each company's corporate presentation, located on each company's website. For Red Cloud Securities, Inc., I would highlight this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell securities. And we note that this call does not take into account the particular situation or needs of individual investors. Participants should rely on their own investigation and seek their own professional advice before investment. So with that out of the way, we'll get into the presentation. So first up, we'll turn it over to Kyle Floyd, Chairman and CEO of Vox Royalties. Kyle, go ahead.
Thanks, Derek. And Derek, on behalf of everyone that's presenting, thank you very much for the effort that Red Cloud has put into the royalty space. It's a very exciting time to be a royalty company and operating in the sector that we do, and also a privilege to be presenting along with Nomad and Trident. So thank you. For many of us on the line, or many of you on the line, Vox is certainly a new story, but we are far from a new company. Vox has actually been the fastest growing royalty company on the planet for the last 12 months. And that's bar none. That's everybody from the new entrants to the majors. And that growth has really been underpinned by a very long track record in the space of being disciplined allocators of capital in the royalty markets and building quietly unique IP, deal sourcing networks, and capability to be in front of royalties and more royalties for that matter than any other company. This foundation of growth it allows us to find unique opportunities around the world. It allows us to find opportunities that we are able to transact on at great relative value, and has allowed us to really reach critical mass as a company and with a portfolio of assets that is staged to create a lot of value for our shareholders. The reason why we're all here today, or most of us are here today, is that the royalty space has outperformed basically any commodity benchmark you can throw at it for the better part of the last 2 decades, be it spot gold, be it ETFs, be it any version of the GDXJ or GDX, and also the S&P 500. The royalty sector is made for investors that want that commodity exposure, but at less risk. And that's what drives the valuations and some of the premium multiples you see in the royalty space. What I'm here to do today is to tell you why we believe Vox Royalty Co. is going to outperform the royalty sector overall. The foundation of our company and of our business is really our team. And I'm really excited to be able to start introducing our team to the capital markets. Simon Cooper is both a mining engineer and geo and has been with us now for almost 6 years. Simon's worked at some of the most interesting projects around the world, from Australia to Central Asia to Glencore's operations in the Congo, and brings just a tremendous ability to understand projects at a technical level, and then also be able to commercially transact with a very significant range of counterparties. Spencer Cole and Rian Easterhusen joined us from Mineral Royalties Online, a company which they founded which created the world's largest proprietary database of royalties that underpins a lot of our intellectual property and our ability to grow in the fashion that we have and at the value that we have. Spencer and Rian. Spencer is a mining engineer, but also brings investment banking and corporate finance and capital markets expertise to the table. And Rian's a renowned geologist based out of Perth for us, with experience working for really the who's who of majors, leading their grassroots geological campaigns. As I mentioned, it's a team with almost 40 years combined expertise directly in the royalty industry itself, with more than $1.5 billion in transactional experience in royalties, with a team that is very technically focused on the front lines at finding immense value in the underlying projects and the royalties overlaying them. We have been very, I would say, strategic in how we have allocated our team around the world. We have 2 individuals in Toronto, myself in Denver, Colorado. We have Rian Easter, who's in Perth, Australia, and then 2 individuals in Cayman for the tax benefits. We have 6 senior execs in all. Our senior exec team is large for an emerging company, but it is there and it is built around the immense amount of transactional volume that we've been able to build that is really upswelling every day and that we continue to bring into our portfolio. That being said, we continue and we will always have one of the lower G&A thresholds in the royalty industry. Vox and this chart illuminate some of the growth that we've been able to drive for our shareholders and for our portfolio of royalties. We have had really exponential level growth for the better part of the last 2 years, and that growth is only increasing in velocity. That growth is not just growth for the sake of growth, it's growth at phenomenal multiples, any way you stack it up, whether it's price to cash flow or price to NAV, on very interesting assets, buying great value at where assets stand today. But really with our technical expertise and technical backing of our team, we're buying assets that have great catalysts in front of them. So the value that we're buying our average royalty at is very in favor of our shareholders and growing our business. And you combine that and overlay that with just the exponential level growth, we're really building a significant amount of accretive value for our shareholders every day. Our pipeline continues to become more robust. We're actively evaluating more than $500 million of royalty transactions across countless royalties. We will not bring in all 500, obviously, but we will be continuing to bring in large volume of royalties at very good prices for our shareholders on an accretive basis, and there's no slowdown in sight for us. As I mentioned, one of the underpinnings of our ability to transact the way we have in the royalty space has been the acquisition of intellectual property. We paid a very significant amount for this, and it was really, in a lot of ways, a transaction that has fueled immense growth at immense value for us. This royalty database was created by Mineral Royalties Online, and the 2 founders, Spencer Cole and Rian Easterhuizen, who joined our team in the IPO, built this database from the ground up using primary sources of data. Countless hours, countless years have gone into this database. The database gives us a few edges in the marketplace. One is just royalties that aren't very well known or broadcast or available to find. And so that gives us really the ability to look at royalties where others may not be looking. And then secondly, the ability for us to transact quickly and efficiently from information to transaction close. We're able to take information, for example, we're able to overlay, are there reserves and resources on a particular tenement, overlay that with does the royalty exist on the tenement, and then overlay that with who is the owner of this underlying royalty. This has allowed us to find royalties in obscure places, from telecom companies to hearing aid companies, to most recently a 3D printing company, as we announced today, that we purchased a very interesting gold royalty opportunity from. Vox at a high level for you, for most of you, this is a new story. We're a precious weighted royalty portfolio. We will always be precious weighted. That's as much organic as it is anything, with our proprietary database and just the overall volume of royalties being more weighted to precious than any other commodity. It organically drives that weighting for us. The other thing to note is, yes, we're very Australia weighted. We have 3 Australians on the team. And we have immense local, what I would say, sourcing networks and information networks that allow us to have a real edge in that marketplace. And it's fueled a lot of our growth. Australia being probably the preeminent mining jurisdiction for gold is something that we're proud of and that we will continue to have a focus on. We will continue to expand that exposure as we have across the Americas and Africa to an extent, but we will always have a very significant of our exposure weighting to Australia for the organic reasons I mentioned. The other thing to note about Vox is we are exponential in terms of our royalty portfolio growth, but where we're really also exponential and growing significantly is amount of assets that are going from development into producing and then cash flow falling to the bottom line from those assets. And that's something that our shareholders can look forward to at an immense rate over the next couple of years for our business. This is just the organic growth in terms of producing and will be cash flowing assets for Vox in our portfolio. Most of this is very precious weighted, and we expect beyond this organic growth that's, I would say, predominantly gold focused, to see a number of acquisitions come in the very near term that drive this amount of producing assets and cash flow to the bottom line higher. But that is to come. This is just what's organically in the portfolio now. And we're also excited to say there are a lot of assets that we have in the exploration development stages that are frankly even exceeding our expectations. We've clearly inherited a very good market for precious metals right now, and that is spurring development even faster than what our technical opinions were on some of these projects. It's spurring faster growth, and we're very excited about that. So really, at an organic level, you're going to see a lot of action in the Vox portfolio, which we're very proud of. Really an anomaly for a company entering the markets is having this amount of counterparties and diversification in assets. We've reached critical mass in our portfolio, and one of the benefits of that is we have a number of different counterparties, some of the who's who in terms of gold producing companies in Australia, and even going down to some of the explorers and developers. They're well cashed up, and they're aggressively and actively moving their projects forward from development into production, and our exploration codes moving those exploration codes into development stages. And we're excited about this level of diversification that we have and the strength of a lot of our counterparties. Really quickly, we wanted to be able to give you, and I apologize, we only had about 10 minutes, so if it seems like I'm rushing, maybe a little bit, but we're trying to give you the full picture on Vox as succinctly as we possibly can. Koolyanobbing is a producing iron ore royalty that we acquired from a telecom company, if you can believe it. Very interesting asset. Adam will probably talk more about this asset, but it's one that we really like and we feel really good about, and is going to create a lot of value for our shareholders. Pedra Branca is the largest undeveloped PGM project in all of South America that is on its pathway towards late stage development and production. And then Bowdens is the largest developing primary silver project in all of Australia. This is another fantastic royalty, giving our shareholders immense exposure to silver at a royalty level. Ashburton is really an elephant out there. It's an acorn in our portfolio. Ashburton is a 1.7 million ounce resource held by a gold major in Australia. There is potential that this asset could be in production in the next 3 to 4 years. With the environment that we're in, we're excited about the potential for Ashburton. It's that elephant, it's that acorn that's sitting in our portfolio that can be what we think will be very, very significant for our shareholders over the next few years. Dry Creek is a royalty over RNC's Higginsville operations, which have been very successful. It is a royalty that was under the radar screen. It was a 1992 royalty that was created that for most of the world was not known about until we found it using our sourcing edges and IP, which brought this royalty to light, and we were able to transact on it. Mount Ida is a near-term producing gold royalty that we acquired from a hearing aid company. And these royalties really showcase how we find value in obscure places and do it in volume at great prices and accretive prices for our shareholders. So why Vox? Why invest in Vox over the abundance of opportunities that are out there, and some very good opportunities in that? Vox, over the last 7 years, we built an unmatched team of industry experts in the royalty space that have both the technical expertise, but also the capital markets and commercial expertise to get deals done at great value for our shareholders, and then be able to take that value to the markets and bring that for our shareholders in extremely accretive ways. We've reached critical mass. We've been on this exponential growth curve for now the better part of the last 2 years, and that's continuing. But this critical mass really gives that diversification to our shareholders. It allows our shareholders to benefit from 40 royalties that have been amassed with numerous counterparties, with cash flow coming and producing assets coming from a number of those different counterparties over the next couple of years, which really we expect to fuel shareholder growth and share price appreciation, both in the short term and in the long term. And then with the technical team, we continue to find royalties that have immense near-term catalysts organically. That organic growth is always going to be extra fuel to the fire, so to speak, beyond our acquisitional growth. And that's something our shareholders have already seen us deliver at Vox, and we will continue to deliver that in terms of that organic growth that's continuing to add value for our shareholders without purchasing even new royalties. That growth should continue to be reflected in our share price. And so with Vox, and why now? Right now, the pipeline's fuller than it's ever been. The 40 royalties are fantastic, but the growth ahead of us is really just the tip of the iceberg. There's so much beneath the surface for us that is going to come to light and come out to the markets over the next 12, 24, and 36 months that we're so excited about. And and it's not just the volume that we have, it's significant increases in number of producing and cash flowing assets. And those acquisitions are being done at just highly accretive value, really driving shareholder value, both in the near term and for the long term. And so we're very excited about the future for Vox. And thank you for your time in this presentation.
Thank you, Kyle. We'll go quickly into questions. We got one from Adrian asking, do you have any estimate for the company's cash flow for the fiscal years 2021 or 2022, or an estimate of the NAV of your assets would be great. Thanks.
Yeah, good question. Right now, most of the major royalty cos and major mining companies have withheld on guidance under the current COVID situation. We expect after we announce Q2 results to come out with our cash flow forecast. But I can tell you on a NAV basis, we're about 1x NAV. And we believe fundamentally with our growth and the accretive nature of our growth, that the market's is right now not pricing in the organic growth that we're going to realize. And it's also not pricing in our growth appropriately for what that means for our shareholders and what we think will deliver in terms of shareholder returns.
Okay. And then just obviously guys are off to a strong start coming out of the gate since it's coming public. You've announced three acquisitions, two this morning. When should we expect that fourth one? Because I guess you said coming out of the gate there was potentially 4 that you were close on. So when can we expect that fourth one, and how is that one going to look compared to the other 3 that you've announced already?
Well, Derek, you promised no easy questions, and what we are going to continue to update the market. We will, to be honest, we're not going to continue to come out with guidance on LOIs, okay. But I can tell you that there is more there, and we will continue. We announced that we would have 4. That is a bar we can trip over. So you will continue to see a significant amount of announcements in terms of deal flow from us on new transactions. We will generally announce transactions at the definitive doc stage when they're formally closed.
Okay. Yeah, it's as we all know, there's lots of deals die at the LOI stage, so it's a tough.
Sure.
Sometimes that bar, you don't necessarily want to get too far ahead of yourself. Question from Eric: are you guys looking at anything in Canada in particular, or is the focus more on Australia just because that's where your expertise is?
Really good question. We're worldwide in terms of focus. We have a team of 6 because we can't handle the amount of deal flow that we have, and that deal flow is really across the world. What we prioritize is what's going to move the needle most for our shareholders on a long-term basis. And when that opportunity is in Canada, we transact on it. What you've seen for the most part is the industry's grown boardroom to boardroom in Toronto and Vancouver, and prices generally over Toronto-based assets have reflected that. And so we've found better value, frankly, outside of Canada at this moment in time.
Right. And then obviously you guys are at a very early stage in the growth trajectory of a royalty company. There's a question here about the projected potential distribution rates in the future, assuming a dividend policy, et cetera, is what that question relates to.
Yeah, we've seen a lot of royalty companies come out with very marginal and de minimis dividends. I can tell you at our growth rate and our ability to deploy capital at such accretive levels, a dividend right now doesn't make sense. I don't think it moves the needle for our shareholders, where I think we're a growth engine, and every dollar that we can put back into that growth is what really moves the needle for our stakeholders. So eventually, when we cannot grow as accretively or at the, let's say, increasing velocity that we have been, then it becomes, are you a dividend paying story, in which case the dividend would go up significantly and be very meaningful, or is there a different type of exit that you look at?
Right. Okay. And then I guess, maybe over the next sort of 12 to 18 months, can you give us an outline of what investors can look for from Vox?
Yeah, I think it's a continuation of what we've been able to deliver for our shareholders to date. We've been very disciplined allocators of capital. We've closed over 20 transactions in our history. That's yielded almost $100 million of shareholder value. We've had to be, as a private company, great stewards of capital, really protecting shareholders' interests. We're going to continue to do that. Management owns almost 15% of the business. Every decision we make is in terms of creating long-term shareholder value for our stakeholders. We'll be the longest of long-term shareholders. So really with Vox, you're going to have this continuation of this exponential growth, I think, in all the categories that matter. That's volume of royalties, increasing our critical mass, and then also increasing our number of producing and cash flowing assets at very accretive levels.
Okay, great. Thank you very much, Colin. With that, we'll leave it there and we'll move on to our next presenter.
Thanks, Derek.
So next up is Joseph Delaplante, CIO of Nomad Royalties. Joseph, turn it over to you.
Thanks very much, Derek. It's a pleasure to be presenting as part of this panel today. For those of you out there that don't know Nomad, maybe I'll just start with a quick background on our company. This is an initiative that really took shape in the latter part of 2019, just after my partner, Vincent Metcalf, and I had left our previous employer and were looking essentially to start a new company. Both of us are from more of an entrepreneurial background and wanted to have the opportunity to create a new vehicle that we could take on over the next few years. And Nomad really came together after discussing with Orion Mine Finance, who are a major player in the mining space. They're a private equity fund. And at that time, they were, shopping a fairly substantial portfolio of royalties and streams. And so after discussion with them, we saw an opportunity to create a vehicle that's sizable, that had cash flow, and would really provide us with a great entry point into the royalty space. And so we announced, we worked towards announcing a transaction. We announced our transaction in February of 2020. And then fast forward 3 months through a global pandemic and financial crisis. And we closed our transaction in late May and began trading on the TSX under the ticker NSR in what we believe is most likely going to be one of the strongest gold environments, and certainly a great time to be starting a royalty company. So with that, I'm going to launch into the presentation. What better place to start than the team? Nomad, we're fortunate. The three founders, myself, Vincent Metcalf, Elif Levesque, we've had the benefit of working together over the past 5-6 years. Together, we've built a precious metal royalty vehicle, and we've had the opportunity to essentially work on every type of transaction that you can encounter in this space, from buying portfolios, buying single asset royalties, structuring new streams, taking part in complex project financing. So from that point of view, we're fortunate to say that we're hitting the ground running. There's no learning curve. And an interesting thing as well is that we're all kind of in our late 30s, early 40s. And so what we're really trying to do here is bring a new energy into the royalty space. And same can be said for our board of directors. In addition to Vince and myself, we have Istvan Zole, who's one of the lead portfolio managers at Orion. Gerardo Fernandez is VP Corporate Development for Yamana. Matt Golat, VP Corp Dev for Premier Gold, and Jamie Porter, CFO of Alamos. So very young transactional board. Every individual on the board has been involved in many deals and many financings, and so none of what we're doing is new to them. And in addition to that, we have Robin Wiseman, who spent just over 20 years at IFC, involved in many types of mine financing in many types of jurisdictions. So a very strong board, fully aligned with our strategy and what we're trying to achieve. In terms of our strategy, the way we built this company is we really wanted to build something that reflects our experience in the royalty space. Royalty companies are meant to deliver meaningful returns at a lower risk than your typical gold and other mining investments. So when we built this company and when we structured our transaction with Orion, we really wanted to come up with a strategy that reflected our lessons learned in this space. So we're going to be taking on the royalty space in a bit of a different way. And really the key thing for us is we want to be providing stable cash flows at a lower risk, at a lower rate of volatility. What that means is we are going to be focused on diversification. A high level of diversification within our portfolio is something that we want to achieve over the next few years. We're coming out with already a fairly diversified portfolio. It's something that we want to build on, and within the next 2-3 years, ideally, no particular asset or jurisdiction is worth more than 5 to 10% of our NAV or revenues. The other thing that we want to do is we really want to focus on cash flow. And again, going back to the theme of delivering lower risk returns, we really believe that royalties are meant to deliver cash flow. And what we mean by that is if as a mining financier, if you take on too much risk within your portfolio, the company becomes harder to understand for your investors. So we want to stick to easy to understand fundamentals. And so we are going to be focused on later stage opportunities, near cash flowing or already cash flowing. Something that's also an area of focus for us is to stick to low G&A and high dividends. And that's also as a result of the last 5 years spent in this space. And it's a question that's asked about the broader space in general is, why are G&A budgets so high and why are dividends so low? And we fully agree with that. So at Nomad, we want to have one of the lowest G&A budgets in the space. And we want to have a dividend that is significantly higher on a yield basis than where your typical royalty dividends are at. So we're going to be announcing a dividend policy over the next few months. We expect it to be substantial, and we want that to be a differentiating factor for Nomad. And really, on the G&A side, what it comes down to is keeping the business simple. We don't have an offshore subsidiary. We're not going to be listed in the US for the time being. Everything that we do is going to be focused on low cost because ultimately every dollar that we save goes back into the dividend and drives returns for the shareholders. So why Nomad? Well, because we're building a precious metals royalty company again. As I mentioned, this is something that we've done before. There's no learning curve for the team. We are hitting the ground running. We have a important pipeline of transactions that we're advancing. And really what this represents, it's a ground floor opportunity for investors to come into a new royalty company. It's not every day that royalty companies of this size and scale are created. And as we've seen over the last 10 years, this business model can deliver significant returns and value creation. And if you look at essentially every royalty company on the precious metal side that's been created over the last 10, 15 years, buying it on day one would have been a great investment. So this is an opportunity to get into a new company at the ground level. We're 100% precious metals focused. We'll walk through the assets in a minute, but that's something that's key and very important to us. We have meaningful levels of cash flow, and that cash flow really, it's all margin for the most part, and that's the beauty of the royalty model. We can deliver really high margins. and fundamentally because we're going to continue to grow the business in a way that's accretive for shareholders. If you look at what we've achieved already this year, the list is long. So we started the year by announcing our third co-founder, Elif Levesque. She is our CFO. She is hands down one of the best CFOs in the mining space. As I mentioned, we worked together at our previous company building a precious metals royalty business. She has experience as an operating company, as CFO of exploration companies, so a great addition to the team. We've also completed our financing. We graduated from the venture to the TSX and began trading under the ticker symbol NSR, and we closed our transaction with Orion and Yamana. That being said, we have a very busy year ahead of us as well. We are working on many transactions that we hope to close in the near term. We do expect to announce our dividend policy very shortly. We are, in the broader theme of building liquidity for this vehicle, we are looking to have an OTC listing that will allow US investors to invest more easily in Nomad. And we are working on a credit facility, which will be one of the main tools that we use to fund our growth. And then just generally increasing market awareness, building the research coverage, and increasing the overall trading liquidity for Nomad. So if we look at where that brings us today, we are currently about $650 million market cap, fairly tightly held shareholder base, with Orion owning just over 77%, Yamana owning 13%. But the way to think about this is really a starting point. We didn't come into the royalty space to build a $600 million vehicle. We are really looking at the longer term for this company to build an intermediate or major royalty company in the $2 to $4 billion market cap range. So what that means is that we will be looking at growth perhaps on a more aggressive basis than some of our peers. And Orion and Yamana are fully behind us from that point of view. These are their investment in Nomad is a long-term investment for them, and they are looking to us to build this into one of the next big royalty vehicles. Here's a snapshot of our portfolio. Given the timing restraints, I'm not going to go through on an individual basis for each of the assets. What's important, though, is to see that it's fairly diversified from a global point of view. That's something that's key to us. As I mentioned, diversification is something that we want, and it's as much in terms of number of assets than it is in terms of number of geographies. So that at the end of the day, we don't have one identifiable jurisdiction that we focus on. We really want to be globally diverse, obviously staying away from some of the higher risk jurisdictions. From an overall portfolio point of view, what that means for Nomad, on a metal breakdown basis, we are 100% precious metals. That is something that we hold dear. We will not be going into exotic commodities, bulk materials, anything of that nature. In time, we may look at small levels of some of the more favored base metals like copper. But fundamentally, the goal of this company is to deliver precious metals exposure. And then just as importantly, on the right-hand side of the page, you see our asset breakdown from a development stage point of view. And this is a direct differentiating factor, I think, versus some of the other companies in the space. Is we have a large portion of our NAV that is from producing assets, or assets that will be producing within the next 12 months. So as of today, we have about 50% of our NAV from producing assets. There are two assets in the portfolio that are in the later stage of construction and are expected to begin producing, one of them before the end of this year and the other by Q2 next year. And once those assets have come online, 85% of our NAV will be from assets that are producing, with the remaining portion of 15% being from mostly satellite zones to existing major mines. And that's something that's very important as an investor when you're looking into an investment in a royalty vehicle. The fundamentals need to be easy to understand. And the easiest thing to understand in our view is cash flow. And that's why that's going to be an area of focus for us. It's something that's unique about our portfolio today, and we want to maintain that with our portfolio as we continue to grow. In terms of size of the deliveries, we're looking at 2021 being our first full year of production. And indicatively, we are, in terms of size, expecting 25,000 gold equivalent ounces next year, which, when compared against some of the other royalty companies in the space, is fairly meaningful for a new company. I think it's important to just mention in terms of the overall royalty space, one of the questions we get asked a lot is, how are you guys going to compete? If you look at the evolution of the royalty space over the last 15 years, clearly there's been a significant amount of growth, both in terms of the aggregate market cap, as in terms of the number of royalty companies out there. In our view, this simply reflects the fact that there's more to be done in the space. We created this company because we think there's a unique opportunity, as some of the bigger companies focus on larger transactions, for companies like Nomad to come in and focus on a different tier of the royalty space, and look for high levels of growth by focusing on those smaller transactions. And as we often say, we've been in the royalty space for 5-6 years. There's never been a time where we've been bored. There's always lots of transactions to look at, and the model is great because it's flexible in the sense that it works in good markets and in bad markets. There's always something to be done in the royalty space. From a valuation point of view, this is really the opportunity. So we created Nomad, essentially to re-rate our portfolio to that of the existing royalty companies out there on the precious metal side. The immediate prize is to be valued, at the same levels as some of our peers like Maverick, Sandstorm, and that provides kind of that near-term re-rating potential. But obviously, the bigger prize in the space is to create that vehicle that's rated like the top three, that are trading at significant premiums to the rest of the royalty space. It's an opportunity that's out there. We want to be a catalyst in terms of making it happen. We are 100% focused on growing the business, whether it's buying royalties, buying portfolios, consolidation within the space. We want to be a catalyst to create that next big royalty vehicle that provides an alternative to the big three. On that front, what's important is our approach. I've talked about a different approach to the royalty space. We strongly believe in partnership within the junior royalty sector. It's to the benefit of everyone to look at transactions together and provide those syndicated bids that can be competitive against some of the bigger peers. So we're going to be trying to lead the charge on this front. It's something that we've done in the past. We know there's a lot of interest in the space for this type of approach. And so, really what it takes is effort and dedication, and that's something that we want to do. And from that side of things, M&A as well is something that's not been very much taken on in the royalty space. So that is something that's on our radar. As we grow our business, as we get the liquidity and the multiples, we will be looking at all these alternatives for our growth. And then to finish, really, it's a simple business. Keep it simple, focus on fundamentals that are easy to understand, build cash flow, have a low G&A, and simply think like owners. Myself, Vince, Ilif, the three founders of Nomad, we're all taking shares in lieu of salary for our first year. We have a fairly sizable component of this company. We are shareholders first, and that's how we want to drive this company forward, by thinking of shareholders first. So on that note, I will end the presentation there, and if there's any questions, I'd be happy to take them. Sure,
thanks, Joseph. A couple of questions have come up. One maybe we'll ask at the end again, but with the rising gold and silver price, is that affecting the timeline / valuation when you're trying to execute transactions?
No, and I mean, listen, I think there's always dynamics you have to take into play when you're structuring these transactions. As an example, the deal we did with Orion and Yamana, we structured in December, and we announced in February, in a much higher commodity price environment. One of the unique things about our business is because we're new, and there's a big desire, I think, on the part of vendors to take back shares of Nomad. it's to the benefit of everyone if we're in a rising price environment, because ultimately we're bringing on board shareholders, and if we benefit, they benefit. So far, it has not been a problem. And I'd also say that it opens doors, right? In these types of environments, a lot more vendors are looking to monetize interests in royalties and portfolios. So it just means more business for us.
Right. You mentioned something in there about structuring the Orion deal. Obviously, Orion owns a significant amount. The quick math that I did on that slide was that about 92% of your float is tied up between management and Orion and Yamana. What are you working on to sort of make your stock a little more, I guess probably trade a little bit more, a little more free float? Is that more sort of share type deals to help you with that?
Yeah, it's a number of things. Naturally, share deals help on that front as we bring in new vendors, become new shareholders. It provides a new position down the road that can be accessed for liquidity. Generally, increasing market awareness, so research coverage, staying close to the brokers. Those are things that we're focused on. On the financing side of things, those will be opportunities down the road. But I think something that's important to understand is that Orion and Yamana came into this story as long-term shareholders because they wanted to achieve kind of higher valuations on their assets. But in structuring this deal, there was a meeting of the minds in the sense that everyone at Orion and Yamana understand that they also will play a role in providing liquidity for Nomad. And so as we build the company, as we do transactions, as we increase market awareness, they will have a role to play, and that role is well understood. And so they're going to be good partners from that side of things.
Sure. And just a couple of quick ones. This is a good question. What's the average mine life of your producing assets or near-term producing assets?
So the portfolio, we didn't have much time to go through it. There's an exception in the portfolio, which is Blyvor, which has the potential to be a very, very long mine life. It's 26 million ounce resource. For the rest of the assets, generally in the 10 to 12 year range is what we'd say.
Okay. That's a good mine life, and lots of room to explore and add free upside for NSR.
And that's the important thing, right? The important thing is when you look at royalty companies and how value is created, an important component of that is royalties kind of being in producers' portfolios for a long enough period of time that they can invest in expansions, exploration, increase resource base. That's something that it's a great question, actually, because it's something that we look at when we do these deals. We look at what's the potential for the operators to drive further value by doing those types of activities. There's great examples within our portfolio that when we bought them, they were closer to 6-7 year mine lives, and they're already at 10-12 year mine life. So that's an important part of the value creation process in royalty companies.
Yeah, and I think with the market picking up, with more capital available for exploration and development cos and producers, they have the ability to add value for you. The beauty of the royalty model, I guess, is
exactly
that's what it comes down to. I think with that, there are a couple more questions, but I think we'll have to either save those for the end or for another time. Thank you everyone for asking, and thank you, Joseph, for presenting. We'll move on to our next presenter. So next up we have Adam Davidson, CEO of Trident Royalties, and as far as I know, the only London-listed royalty company out there. So a unique start. Go ahead, Adam.
Yeah, thanks, Derek. Thanks for the opportunity to join you all today. Yeah, so as you mentioned, Trident Royalties, I think we might actually be the newest listed company in the royalty space, which is an achievement considering all three of us on the webinar today are relatively new, but we just listed on June 2nd, so I've been trading on the AIM in London for just about 2 weeks. But yeah, so Trident Royalties, let me skip past that. So yeah, Trident Royalties our intent is to build a diversified mining portfolio. Something along the lines of something that's broadly reflective of the mining sector by commodity breakdown. So by that, I mean circa about a third precious metals, a third base metals, and a third bulks and batteries and industrials and sort of everything else. Which, depending what lens you're looking through, is roughly the breakdown of the mining sector, whether it's by global revenues or global market cap. And so on. I suppose the basis behind that is the fact that we've all sort of extolled the virtues of royalties, and I think most people who are listening to this webinar sort of get that and understand that. And what we found is there's a huge pools of capital that say, okay, I like the royalty concept and understand it, and I want to get my, particularly retail and generalist investors, I want to get my 4 or 5% portfolio allocation to mining commodities via the royalty approach. But then, how do I do that? At the moment, you'd say there are very few options that give you sort of that broad sweeping exposure to mining commodities. So I'll talk a bit more to strategy on one of the latter slides, but that's really the intent and what we're starting to execute on. But maybe pause there just briefly and talk to the team that we've assembled. So myself, I'm based in Denver. And joined Trident at just sort of the tail end of last year. Prior to that, was with a group called Resource Capital Funds, which is a mining-focused private equity fund. I was with them here in Denver and then also down in Australia for a couple of years. I've got my colleague Tyron Reese also down in Australia, was with RCF as well, but a metallurgist by trade. Prior to that, was with Newmont Gold Corp and before that with Sandfire. And then our board is seated in the UK. We've got James Kelly as our chairman. James is former Xstrata, later Glencore, and then was one of the founding team of Greenstone, which is the UK-based mining fund. We've got Mark Potter, who's currently the CIO of Metal Tiger, which is a name-listed mining investment vehicle. But probably more pertinent for us, he was recently the CIO of Anglo Pacific, which is the only other London-listed mining royalty company and the largest diversified mining royalty company. So brings a lot of experience and expertise. And then finally, we have Al Ghuli, who is the managing partner of Fasken's law firm's London office. So in addition to executive roles he's had in the mining space, obviously a sort of 25 plus year career from a legal perspective. And so we listed on June 2nd, and concurrent with that, we closed on our fundraising, which was 16 million pounds at today's exchange rate, sort of just a touch above 20 million US. And then we've got a debt mandate with Tribeca Global Resources. It's still advancing discussions at this stage, but hopefully that would, in the near term, then unlock another 10 million. So it gives us quite a bit of capital then to execute on our strategy. And then importantly, the day after our listing, we then formally closed on our first royalty transaction. So this is a royalty over the Deception Pit of Koolyanobbing, which is operated by Mineral Resources in Australia. Importantly, this acquisition was done with the cash that was in the Trident vehicle prior to this raise. So the full 20 million that we raised is deployable to acquire new royalties. So that that sort of sets us in good stead. The cash flow from that royalty was last year just under 2 million Aussie. This year we anticipate that that's going to increase. The operation has been ramped up since the beginning of last year. Was running at a 6.5 million ton per annum run rate, has been ramped up to 11 million tons, and then MinRes has allocated another 120 million Aussie to further ramp it up to 15 million ton run rate by the end of this year. So we'd anticipate that to more than comfortably cover our G&A, which is around $1 million US per year prior to any deal costs. So that royalty, if it's paying circa sort of 3 million Aussie, should more than cover that, as well as give us a bit of cash buffer. But pivoting back to strategy, and I should mention this is sort of an abridged presentation. I'd encourage everybody to go to tridentroyalties.com to sort of look at the full information pack, but conscious that I've got sort of 10 minutes or less here, so I'll make it my personal goal to move pretty briskly. And I think some of the other guys have touched on some of the key points here. I mean, when you look at the royalty space, I think fair to say there are some very big players, multi-billion-dollar market cap companies. But if you rewind the clock sort of 15 years, I think this chart here would have more in the range of 3, maybe 4 companies. So it's clearly not an industry that's in its infancy, but probably could categorize it as in its adolescence, which is why I think there are still opportunities in the space. One of the things that jumps out when you look at this slide is all these companies are primarily listed in North America, with the exception of Anglo-Pacific. So by us being listed on AIM, and that shouldn't scare off any of your Canadian listers, because it's part of the London Stock Exchange and easily tradable on pretty much any platform. But it does open us up to different pools of capital, and I think you see that represented on our register. Some of the institutional shareholders and some of the high net worths that have come in are driven by the fact that the AIM is a more comfortable exchange for them. And probably more fundamentally, I think what you find when you overlay all the royalties of these companies on a global map, unsurprisingly, because nearly all of them are listed on the TSX, there's a very heavy weighting towards North America, and it sort of trickles into Central and South America. And then what you see is sort of a smattering elsewhere. In fact, the other guys on this call are probably one of the 2 sort of exceptions to that, in large part. And that opens up, I think, a lot of geographic opportunity. So, for example, that first royalty that we acquired, it is in Australia, so a great mining jurisdiction. Literally has hundreds of royalties in existence and many more that could be written, but doesn't yet have a publicly listed mining royalty company. So, and it's not exclusive to Australia. That's a pretty ready target of opportunity for us. But there are multiple jurisdictions that really you're not competing with the other royalty companies for the most part. You're largely competing with equity or debt providers. The other thing that probably jumps off this slide is just the fact of how many of these companies are precious focused, and that can be a very competitive space, particularly within a given size. By being a diversified royalty company, it really opens the door with regards to getting very accretive assets into the portfolio. Again, on a relatively non-competitive basis, and I don't think we expect to enjoy the sort of same re-rate that you would expect from the precious guys. Alternatively, I don't think we'll be paying the same sort of valuations. You can probably do the back of the envelope math on the royalty acquisition we've done, and we paid 7 million Aussie for that in a staged consideration. So 4 upon closing a couple of weeks ago, and 3 in 1 year's time. And that's for a quality asset, being operated by a major that's allocating material dollars to ramping up the asset, and fortunately in a very strong iron ore price. So I think there are a lot of opportunities out there, because we aren't sort of exclusively precious focused, and we get the benefit of, as we all know, mining is a cyclical industry. So, as precious may be out of favor, it's the time to put money into base metals and vice versa. So it allows you to be a bit nimble in that regard and target sort of the most accretive transactions possible. So, effectively to that end, what we're going to go out there and do with the capital we've raised is build the portfolio, establish the critical mass. And in that sense, some of the more recent precious guys have laid a lot of the hard groundwork for us with regards to building the critical mass such that you can then facilitate getting lower cost debt to continue to build the portfolio, and then over time pivot to being a dividend payer. And that is pretty critical for us, in particular being in the London market. I think fair to say that the TSX and Canadian investors sort of get the royalty model, and are of course happy to have a dividend, but are also happy to sort of sit back and let the portfolio build. I think being in London, we're conscious that there are a lot of value investors, so getting to the stage where we can pay a meaningful dividend is one of our top priorities. And then trying to keep it on time, I'll touch on the pipeline, because this is obviously a pretty critical consideration for most people. Having raised a good chunk of capital and having that one royalty bedded down, and then through the relisting and IPO process, it's a natural question to ask. So what are you sort of pivoting to next? And like a lot of the guys, the intent is to go out there and continue to build cash flow in the near term. And then I think over time, we'll be progressively moving down the development curve to get earlier and early stage assets. Now, that said, we are in negotiations and hopefully close to closing on a couple earlier stage royalties, because I think that does add a bit of juice and excitement to the portfolio. But really, cash flow unlocks a couple near-term catalysts for equity holders. So importantly, it allows you to lock in that debt, obviously adding fuel to equity returns. And then over time, you can work that debt down to the point where it becomes a lower cost revolver to draw down on. And then it does allow you to start paying a dividend sooner. So once you build that critical mass and have a good level of cash flow, it unlocks those things. So to that end, we're currently pursuing several royalty and one stream transaction. Limited in how much I can say, given market restraints, but particularly in the UK. But I think fair to say that we're looking across all commodities. So that the three buckets that we're targeting, the base metals, the precious metals, and then the bulks, batteries, and sort of everything else, we're actually happily getting a lot of deal flow in all three of those buckets. I think in particular in precious, you'd sort of say that that's a very crowded space. So would you get a good amount of deal flow? And I think what we're finding is, with regards to deal size in particular, some of the bigger boys, maybe deal size isn't the right way to categorize it. It's probably more the asset size. So because some of the bigger royalty companies will write smaller checks on an asset that they think will ultimately be very large. But what you don't see them often do is write, for example, a $5 million check on a royalty that's going to pay $1.5 million a year for 10 years. Now, that could be an incredibly accretive transaction, and for us would be a fantastic royalty, but for them doesn't really move the needle. So what we're finding is there's a bit of a size component in addition to the geographic component. We don't see many of those guys in Australia, and sort of starts to thin out in West Africa and South America as well. So quite a bit of opportunity coming through on the precious front. So we are currently evaluating and are fairly advanced in discussions on paying or very near term paying royalties over lead zinc asset, a gold asset, battery metals asset, and a copper asset. So we'd be hopeful to announce some of those over the sort of next 6 to 8 weeks. And in terms of geographic, similar story. We've got quite a good spread of those four assets I was sort of alluding to. In everywhere from Australia, Canada, Africa, and Peru. And of course, all or none of these may be completed, but I suppose it's encouraging to see that we're getting quite a bit of deal flow and with a lot of capital to put to work. I'm very confident that we'll put that capital to work by the end of the year, or at the very least have good line of sight to having fully deployed the funds we just raised. And from there, as we know with royalty companies, the cycle sort of continues. You get a re-rating in the share price, and then can go out and repeat that process, and ideally drawing down on the debt, as I said, to facilitate that. So maybe I'll pause there because I see that we're out of time. But as I said, I'd encourage anybody listening to go to the website and review the material and some of the more in-depth interviews. And of course, happy to field any questions now or any outreach subsequent to this.
Thanks, Adam. We do have a few questions on the line. One of the things you mentioned in your call was getting to critical mass. Question from Michael here on just maybe can you define that? What does critical mass sort of mean to you as far as cash flow relative to G&A or overall cash flow or market cap or what does that kind of mean to you guys?
Yeah, no, that's a very good question. And in fact, that's one area we're having Mark Potter, with his experience at Anglo Pacific, has been, hugely instrumental. So when he was with Anglo-Pac, he was involved in redoing their leverage package and has facilitated some of the discussions with potential debt advisors and debt providers that we've had to date. The sort of range that you see with regards to debt is plus or minus 2 times pre-tax revenue. So if we can deploy this capital and unlock pick a number, 5 million in pre-tax revenue, that facilitates the ability to go out there and get circa $10 million in debt, which then allows you to sort of repeat that process. And so it's less a matter of sort of a finite line with regards to market cap and more an ability to go out there and meaningfully get that sort of cash flow. Because if you're only able to unlock 4 million in debt, for example, that doesn't allow you to go out there and do meaningful transactions. So it's more of a sizing of unlocking that sort of capacity, I suppose.
Right. Just on the listings, you mentioned obviously you guys are uniquely listed on the AIM. have you guys thought about, from a question from earlier, listing on the ASX or listing on the TSX or one of those other exchanges to tap a different pool of capital?
No, I think absolutely. Yeah, that's something we're considering now. First things first, we've got to go out there and deploy this capital and build a portfolio. But it's something we're very conscious of. And I think, that there becomes a certain point where you reach an inflection point where that makes sense. And it is likely the stage where you've got a meaningful portfolio and are paying a dividend.
Yeah. Okay. And then I guess one of the things, relative to a lot of your peers, you have a relatively strong market cash position relative to your market cap. So obviously that gives you some leverage, some firepower to go out and do some deals. Does that allow you to fly under the radar a bit as well? Whereas other guys you could see them coming, kind of thing.
Yeah, potentially. I mean, I think it's fair to say that our transactions aren't subject to financing at this stage. And we were very conscious when we did the raise for the IPO. We raised it at 20p or 20 pence per share, which is the same price that the Trident shell was originally raised at in 2018. And we did that quite deliberately because I think what we wanted to do is provide incoming investors with the uplift. And we're effectively trading at just a touch above cash right now. So it is an opportunity for people to get in. And as we build a portfolio, you do get to enjoy that re-rate. We're not we didn't want to try to capture that upfront for ourselves as shareholders in the shell for the very fact that we wanted to maximize the capital that we could raise, because it is about building critical mass and having a pool of capital to work with.
Right. And then I guess using that pool of capital, what should investors expect sort of over the next 12 to 18 months from Trident?
Yeah, no, I think exciting times is what they should expect. As I said, we've got quite a few transactions pretty well advanced. And I think by the end of the year, we'll have deployed the capital. I'd be surprised if we didn't. Or at the very least, I think we have deployed a good chunk and we'll have pretty good line of sight. The other thing I'd like to have completed in the near term is finalizing the debt mandate such that we have access to that 10 million to further unlock additional capacity.
Right. Yeah. I guess being able to go into royalties not being subject to financing is a key. Helps you compete. Okay, thank you very much, Adam. Appreciate the taking time to present and being succinct and answering the questions. In the interest of time, I think we're just over an hour now on the webinar, so we'll wrap it up here. I want to thank everyone, all three of the companies for presenting and the audience for attending. It makes it doesn't work without either of you, so very much appreciated. And just as a heads up, our next webinar will be Equinox Gold on Thursday, June 18th at 2 p.m. So stay tuned, and we'll look forward to hearing that. And make sure you go to our news and media page to see all the replays of these events. Thank you very much.